Hello everyone, thank you for joining us today for our midsummer update. Our focus will be on current market economic circumstances and what we believe will be the theme for investment management for the rest of 2020. It's our hope that you and your family are doing well, and despite the current pandemic situation, you're finding time to enjoy what is usually a very brief summer season here in Canada. It's not uncommon, from what I'm told by our northern Albertan clients, that snow may very well be just around the corner. Our presentation today will be given by myself, Mark Tokar, Senior Portfolio Manager and co-founder of Accilent Select Discretionary Management, and Cesar Cosio, Investment Analyst, whose focus today will be on alternative strategy investments. There's no intention to borrow from Dan Seals, the country music artist, but the title of our presentation today is Everything That Glitters Is Not Gold. The title is most apropos to describe our current market circumstances. We'll focus on various areas of discussion that will include our thoughts on waves, not necessarily the ones that you may be experiencing while sitting on the beach soaking up the sunshine, but those that are more closely associated with COVID, government fiscal stimulus, and a central bank monetary policy. It goes without saying that the economy is still being impacted by lockdowns and social distancing policies. Governments, in their desperation, have turned the taps of spending wide open to flood policy initiatives to stave off the impact of the worst economic shutdown since the Great Depression. As such, the specter of debt now looms large on the immediate horizon for all industrialized nations. Complicating an already tenuous situation are continued U.S. trade frictions and a U.S. election that will undoubtedly be remembered for a long time. We'll review all this in the context of our portfolios, their past and present performance, and what approach we'll be taking as the year plays out. COVID has not relented. Hotspots around the world continue to burn on. The US amounts to over a quarter of all cases around the world and over 1/5 of all deaths. Alarmingly, economies that have taken a more cautious approach to the initial wave of COVID and subsequent reopening are now experiencing flare-ups and spikes in cases and transmission. Unprecedented government spending has added stability to the credit and equity markets. As of early April, the US accounts for half of global government stimulus being injected into economies. A staggering $7 trillion has been added to the US government spending bill. That dollar figure has been matched by major industrialized nations around the world. What is staggering is that this is only the first wave of costed stimulus. The US is now putting in motion a second wave of stimulus that is, although not as large, quite significant. Other economic regions are also proposing second and even third wave initiatives. Not only does government debt loom large with the specter of credit downgrades in the future, but so does the shadow of the taxman. All this money will have to be paid off through higher taxes or government cutbacks. Governments aren't alone in their profligate spending. Central banks have set their printing presses to warp speed, creating huge sums of cash flooding into the system like a dam bursting. Never-seen-before initiatives by central banks have now become pervasive in the fight against a deepening economic impact. Central banks around the world have now ventured into the secondary market to provide both liquidity and pricing support, not just for government debt, but also corporate debt, and shockingly, even exchange-traded funds and REITs. Here we list 4 central banks and the effects of their initiatives on their balance sheets. The Federal Reserve has expanded its balance sheet 7 times over by buying assets since 2007. Advanced economies have been blindsided with double-digit drops in output. Some economies have seen in excess of 15% drop in output. Should all go well and the world economy continue to grow without another wave of COVID, the expectation is that the global economy may squeak out a modest growth in 2021. We think that may be a rosy expectation. Based on shaky outcomes like vaccinations being produced and lockdowns lessening and continued relaxed social distancing initiatives that are successful. Usually the 4th year of a first-term president tends to be a positive one for the markets, and this year may be no different. Although, unlike every other fourth-year second-term bid for presidency, this year has had the help of extraordinary government spending and central bank initiatives. Trump fatigue syndrome may find the incumbent president being shown the door. It's worth noting, however, that businesses in general have done exceedingly well with his tax cuts and deregulation. Biden may be seen as a catalyst for higher taxes and unsustainable spending programs like healthcare at a time when the economy can least afford it. In addition, the election takes place during a historically volatile time in the markets that may be further impacted by the return of children to their normal schooling routine that may fuel the next wave. On the whole, markets around the world remain negative, with a few exceptions. US markets have rallied strongly, buoyed by the flood of markets seeking an alternative to zero interest rates. Bonds have responded strongly this year, posting almost a 9% return. However, there is potential for great danger on the horizon for any holding these assets. Gold has made an extraordinary charge on the backs of fiscal and monetary stimulus. Our portfolios have done exceedingly well against their respective benchmarks for the year. We are happy to announce, on a composite basis, that our portfolios have achieved better performance than their benchmarks with less risk than their benchmarks. 2020 saw the return of volatility to historic levels not seen since the credit crisis. Every asset sold off in Q1, and it was only until central banks and governments around the world came riding to the rescue that a bottom was established in March. Our clients dictate our approach, as many are pre-retired or retired, and are seeking less volatility with modest returns. As such, we value their sleep factor highly when it comes to how gyrations in the market affect our clients. As mentioned before, we were prepared for this downturn as we felt that the economy was exhibiting activity indicative of a slowdown even before COVID hit. We built cash balances to exceed 20% and waited out what was a bullish January and February where the markets achieved new highs. We reduced exposure to energy names like Cenovus and Imperial Oil, although we still hold Suncor and Canadian Natural Resources. Perhaps a mistake, although these are the largest producers in the country and inventory of oil is dropping. We also include Bank of Nova Scotia and Bank of Montreal to our portfolios. Their dividend cost yields at the time were approaching 7.25% on average. Today, they've rallied on price in excess of 20%. We actively sought to include cover call writing on utilities and did so with the addition of the Bank of Montreal Utility Covered Call ETF. At the time of purchase, it was yielding 9.09% and amounted to anywhere between 5 to 6% of client portfolios. Today, it is approximately 20% higher and still paying a robust dividend. I'm going to pass the next slide over to Cesar to discuss our alternative strategies. Cesar?
Thank you, Mark. Hi, everyone. As stated by Mark, the macroeconomic environment does not look great, and it is our view that real interest rates will be low and most likely negative for a long time. Therefore, under this environment, we believe gold is a good diversifier. Given that over the long term, gold can be seen as a bond that yields 0% return. In a world of negative interest rates, a 0% return becomes very appealing. We have added four mining stocks into our portfolio. These miners have large gold reserves and low cost of production. With gold prices rising, they will generate high free cash flow, and consequently, we expect them to provide high beta in relation to gold. Year to date, our average gold positions have returned around 70%. Apart from miners, we also hold 4 private equity positions, 2 private REITs, 1 mortgage bridge lender, and 1 royalty fund. Rice Property Trust is a US REIT that has approximately $463 million in assets under management. The fund has yielded a compounded return of 13.13%. To date, the fund has returned a positive return of 1% and is holding over 24% in liquid assets ready to be deployed opportunistically. Tres Capital is a mortgage bridge lender. with a diversified portfolio of commercial and multi-residential short-term mortgages in the United States. The year-to-date performance has been 3.70%, which has been paid in distributions. We believe this extraordinary performance is due to massive government support and combined with good due diligence. We are monitoring the investment carefully, and if we believe the risk reward is not there, we will be looking into exiting this position. Accilent Invest Student Housing is a private Canadian REIT specializing in the acquisition and management of newly built student housing in Canada. As of May 31st, 2020, the fund has approximately $407 million in assets under management and owns a total of 7 properties in Ontario. Additionally, the fund has generated a total return of 23% and an annualized return of 13%. The year-to-date performance has been positive at 2.7%. The portfolio loan-to-value remains low at less than 60%, and the occupancy rate has been maintained at 98%. In July, the fund has entered into a binding agreement to acquire a new property in Edmonton, Alberta. The property is in a prime location close to the University of Alberta. However, we're still waiting for more information to assess the financial metrics of the property. Over time, we expect the investment to provide good cash flow along with capital appreciation. Finally, we hold Rev Royalty Trust. Its assets under management are 6 million Canadian dollars. The fund has investments in private debt, venture capital, and some small cap miners. To date, the fund has returned 8% dividend yield, and we believe the fund to be a great diversifier given the fund's asset mix. Thank you, everyone. I will pass the next slide to Mark.
Thank you, Cesar. We still hold 10% cash on average for our clients, and we're seeking to raise that amount as we go into the fall by reducing exposure to sectors that may be hit by a second wave of selling. There are a few compelling reasons to own equities right now. Much of the valuations have been supported by artificial means through government and central bank interventions. Fundamentally, government and central bank balance sheets are on shaky ground. The specter of inflation or higher taxes is right around the corner. Either way, this will impact economic recovery. Unless a vaccination is found, we anticipate that there is a strong possibility of another sell-off this fall. Thank you for your time. We look forward for any conversations that you might have or questions that you might have for us. Please reach out to us, your portfolio managers, or at our head office here. And we'd love to schedule a call to sit with you and meet with you to discuss your investments or the possibility of investing with us. Thank you and have a nice day.